Hi, everyone. Third time's a charm, Sonu. This is the third ever glass half full. These first two, we've definitely taken some serious turns with everything going on. Talked a lot about the Middle East. We're going to talk more about the Middle East this time, Sonu, but we're going to take a little bit of a U-turn. Will higher gas prices cause a recession? I think that's an important one with everything going on in the Middle East and gas prices, Sonu. How much is that going to hurt the consumer? So I'll just put it on to you, ball on a tee, Sonu. Is a recession coming if crude oil stays up around $100 for, let's say, the next 6 months?
I'll put it this way. It doesn't have to.
Okay.
Short answer. It doesn't have to. Now, to recap where we are, a couple of months ago, nationwide average gasoline prices in the States was about $2.80 a gallon.
Okay.
This is average. This is not to say in your neighborhood it may be more or less, right? In Chicago is a lot more, right? In Cincinnati, where Ryan, you are, probably less. So $2.80 was the average. Today, it's about $3.80 or a little slightly over $3.80. So in a month, 6 weeks, we've gone up by over $1, right, per gallon. And it's not over yet, right? Diesel prices have increased even more. It was about $3.50 a gallon on average several weeks ago. That's up over $5 a gallon. So it's not just gasoline prices by itself. Right. Diesel, you need that to transport food, right? And that's going to increase food prices. You need fertilizer for planting season and all of that. A lot of the fertilizers the world uses comes from the Middle East, from Qatar. Qatar is the second largest exporter of natural gas in the world, right? And then you have all sorts of other things that you need, all sorts of petroleum products we all use. So not just gasoline, what's happening in the Middle East is going to sort of feed into prices over the next, I think, 6-7 months, depending on how long it goes on for. That is a key question.
And that is the key question. Obviously, that's the big uncertainty out there. We've seen the data. U.S. consumers spend less than 3% of their total money consumption.
Less than 2% on
less
average.
Than 2%. Yeah, for your car. But as you gas for your car. But as you pointed out, Sonu, and just said, this is broader, right? If all these things are going higher, you're going to potentially pay more for your chicken wings. You're going to pay more for this. You're going to pay more for that. And you didn't mention, how's jet fuel? That's even, no pun intended. That's soared even more, right? That's gone vertical.
Exactly. That's gone nuts, to put it mildly.
Yeah.
Right?
So,
no surprise.
As messy as it's going to be, as it is, there's these new things you can look at, TSA wait times, and they're getting up there again with this latest, government shutdown, partial government shutdown. But all I know is you go to the airport, it's a mess, and then it's going to cost a lot more potentially for flights. And you looked at a month ago, now you look, they're probably higher. So these are real concerns. The labor market, as we talked a lot about, it's still low, fire. The bottom line, so I think if the labor market cracks, then we're talking about a recession, right? So how is that, in a minute or so, how is the labor market holding up? It's probably early, but what do you think?
So far, it's okay, right? And in an inflationary environment, yes, inflation sucks for all of us, right? But one thing that tends to happen is, look, one person's inflation is another company's or person's margin expansion.
Okay.
That's essentially what happens. Somebody else, let's say global inflation's on the rise. That means input prices for companies are rising, like oil and other feedstock, chemicals, all sorts of things, or petroleum derivatives, right? That's going up. But that means, somebody's benefiting on the other side because prices are going up. Maybe it's an oil producer. It's just who benefits is shifting. That's what's happening. There's a lot of churn right now. Who benefits is shifting. How we go into a recession, though, I think the path to a recession actually lies through the Federal Reserve. We saw this in the 70s, in the mid-70s. We got an oil shock. We got a food price shock. The Federal Reserve really started hiking rates. The federal government is also not spending as much as it is today. That's another thing, right? So that took money out of the system, pushed labor market into a bit of a mess. Unemployment rate went up. That's how we got stagflation. Same thing, 1980, 81. Inflation was very high. But Paul Volcker came in and he raised rates to 15-20%. That crushed the economy, right? We don't think, to be clear, I don't think that's going to happen right now. But if the Federal Reserve came in and said, we are going to increase interest rates, today it's about 350, 360, thereabouts, right? The federal funds rate, the policy rate that they benchmarked it. If they say that's going up to 5%, we have a problem. I don't think they're going to do that, right? Because they are worried about the labor market too. What we'll get, I believe, this year is no more interest rate cuts, right? They're going to sit on their hands. And President Trump is also going to try and jawbone the Federal Reserve into, cutting. I don't think they'll cut, given the inflation picture. But I think the path to a recession lies through a really hawkish, tight Federal Reserve.
Okay, and we're not there yet.
Not there yet.
Just to be clear, it's not like President Trump's the first president to try to jawbone the Fed. You can go down a Google AI Google rabbit hole and look into some of the history.
You had Lyndon Johnson, you had Nixon, you had.
Biden had a closed door meeting that apparently got very heated. So listen, yes, it's political. We don't like to get too political, but yes, the president wants lower rates. It's going to be tough. We've talked before. It's going to be tough. But let's kind of wrap it up. I'll go a little bit, then you can finish it up. Let's talk about some positives. I mean, this is the glass half full. We talked about some potential worries. We don't see a recession, but listen, the odds of a recession, if oil stays high and the Fed gets a little more hawkish, it's higher than it was 6 months ago. But we just wrapped up an incredible earnings season. Earnings across the board came in much better than expected. One of the highest revenue numbers we've seen on the S&P 500 in about 4 years. Earnings do drive long-term stock gains. Now, again, the market's a forward-looking mechanism. The good news, Sonu, even since all this stuff started, companies have had pretty good things to say. The airlines, I can't mention individual airlines, a bunch of airlines just came out yesterday and said, listen, prices are higher. Jet fuel's higher, but demand hasn't slowed down at all yet. Maybe the key word being yet, but we're not seeing any major cracks in the economy being led by stronger earnings, which is still a really overall net positive thing. So, no, again, glass half full. Let's leave the listeners on some good news. Give us some good news as we wrap up our third episode of this.
Yeah, I think we're in an environment, we wrote about this and talked about this in our outlook too. I think we are in an environment of inflationary growth. Mm-hmm. When you usually think of economic growth, people are talking about real GDP growth. Okay. Right. I think real GDP growth maybe runs below trend. That's about 2%, 2.5%. Okay. But then nominal GDP growth, you add inflation to that. If inflation running about 3.5%, suddenly you get to 5-6% nominal GDP growth. Where do profits come from? Profits come from nominal GDP growth. If nominal GDP growth is running about 5-6%, that is not a bad environment for revenue growth. That's not a bad environment for profit growth. Remember, profits come from sales and margin expansion. One company's margin expansion, as I said, is my inflation. Yes. I don't like it, but that's what drives profits. I think that is why we just have to be careful in this environment. I think this is also an environment where you want a diversified portfolio because you don't know who is going to benefit here.
Well said. Bonds haven't done all that well. Stock market obviously struggled lately, but how's the stock market done the last 3 years? We know gold and commodities have done well. So keep that diversified portfolio and you potentially can benefit from whichever group is the next one to take the baton. So everyone, this was fun. Hopefully you enjoyed this new video series we're doing, the glass half full. There's so many things to talk about, so many very, very serious things to talk about. We're going to keep doing these videos every single week. Thank you so much for coming to these. And again, Sonu, the big question was, will higher gas prices cause a recession? I guess our short answer is stay tuned. Not yet, but we don't think so as of now. It's the Cliff Notes version of that. See everyone next week. Take care. Thank you.